Today we are also joined by a group of young women with the ambition of taking my job one day. They are winners of the MPC Schools Challenge for 2019. Let's get on to the business. Since the July meeting of the Monetary Policy Committee, economic indicators confirm weaker global economic conditions and low inflation. Central banks in advanced economies have provided more monetary accommodation, helping to ease global financial conditions. Downside risks from escalating trade and geopolitical tensions remain pronounced. In the second quarter of this year, South Africa's GDP rebounded from the contraction experienced in the first quarter, but economic activity levels still remain weak. Monthly inflation has been around the midpoint of the inflation target range, as food and services inflation remained subdued. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, was 4.3% in August. Goods price inflation in August was 3.9%, while services price inflation remained at 4.7%. Food price inflation rose to 3.9% due to rising cereal and bread prices. The bank's measure of core inflation, which excludes food, fuel and electricity, rose slightly to 4.3%. Producer price inflation for final manufactured goods decreased to 4.9% in July. The medium-term inflation outlook is largely unchanged. The inflation forecast generated by the SAP's quarterly projection model is for headline inflation to average 4.2% in 2019. The projection for 2020 is unchanged at 5.1%, and for 2021 slightly up to 4.7%. Headline CPI inflation is expected to peak at 5.3% in the first quarter of 2020 and settle at 4.5% in the last quarter of 2021. The forecast for core inflation is lower at 4.3% in 2019, is unchanged at 4.7% in 2020, and is slightly higher at 4.6% in 2021. Electricity, food and fuel price inflation continue to shape the near and medium-term trajectory of headline inflation. Fuel price inflation is expected to average 2.4% in 2019 and to peak at 11.8% in the first quarter of 2020. While food price inflation has generally surprised on the downside, it is expected to peak at about 6% in the third quarter of 2020. Electricity prices came out higher than expected in August at 11.8%, but remain in line with the forecast. Inflation expectations have continued to moderate gradually. According to the Bureau for Economic Research third quarter survey, expectations for headline inflation are down slightly for 2019 to 4.6%. Expectations for 2020 remain unchanged at 5% and eased from 5.2% to 5.1% for 2021, reaching the lowest levels since 2007. 5-year ahead inflation expectations also declined to 5%. The inflation expectations for market analysts in the September 2019 Reuters Econometer survey have been revised lower to 4.3% for 2019 and remain unchanged at 4.9% and 4.8% in 2020 and 2021 respectively. Market-based expectations implicit in the break-even inflation rate, that is the yield differential between conventional and inflation-linked bonds, have remained stable since the previous MPC. 5-year break-even rates are currently about 4.6% and 10-year break-even rates at 5.4%. Global GDP is expected to slow to 3.2% in 2019 and rise to around 3.5% in 2020. While global growth remains resilient, recent indicators on trade and manufacturing have deteriorated and a range of downside risks to growth remain. Growth in world trade volumes has continued to decline, with trade tensions weighing on market confidence and lowering investment. Other downside risks include geopolitical developments, further oil price shocks, and high levels of corporate and sovereign debt. Across most countries, there is limited policy space to respond to shocks. Inflation outcomes and inflation expectations in most advanced economies remain below targeted levels. Barring significant shocks, monetary policy in major advanced economies will remain accommodative over the medium term. However, market expectations of further accommodation appear high, creating ongoing risk of market volatility should these not materialize. Since the July MPC, the rand has depreciated by 4.6% against the US dollar and by 3% against the euro. The implied starting point for the rand is 14 rands 88 cents against the US dollar, compared with 14 rands 40 cents at the time of the previous meeting. At these levels, the QPM assesses the rand to remain slightly undervalued. While the rand has benefited from improvements in global sentiment, investors remain concerned about domestic growth prospects and fiscal risks. GDP rebounded to 3.1% in the second quarter, following a decline of 3.1% in the first quarter. The sharp quarterly rebound was caused by stronger output in nearly all sectors, including investment and government consumption spending. However, longer-term weakness in most sectors remains a serious concern. Based on recent short-term economic indicators for mining and manufacturing sectors, the third quarter GDP outcome is expected to be muted. Business confidence has declined further. The ABSA Purchasing Managers Index came out at 45.7 points in August, and the RMB BER Business Confidence Index fell to 21 points. The SAPS Composite Leading Business Cycle Indicator also continued to trend lower, although the coincident indicator remains positive. The forecast of GDP growth for 2019 remains unchanged at 0.6%. The forecasts for 2020 and 2021 have decreased to 1.5% and 1.8% respectively due to revisions to global growth and domestic potential growth. The MPC assesses the risk to the growth forecast to be balanced in the near term, but remains concerned about medium-term growth and weak employment prospects. Escalation in global trade tensions, further domestic supply constraints, and/or sustained higher oil prices could generate headwinds to growth. Public sector financing remain high. Public sector financing needs remain high, exerting pressure on the currency and pushing local bond yields higher relative to country peers. Implementation of prudent macroeconomic policies and structural reforms that lower costs and raise investment and potential growth remains urgent. The overall risks to the inflation outlook are assessed to be largely balanced. Demand-side pressures remain subdued, and food, wages, and rental prices are expected to increase at moderate rates. Global inflation should remain low. In the absence of shocks, relative exchange rate stability is expected to continue. Some upside risks to the inflation outlook remain, in particular from fuel, electricity, and water prices. The MPC welcomes the sustained moderation in inflation outcomes and the fall in inflation expectations of about 1% since 2016. The committee would like to see inflation expectations also anchored closer to the midpoint of the inflation target range on a sustained basis. Against this backdrop, the MPC unanimously decided to keep the repurchase rate unchanged at 6.5% per annum. Monetary policy actions will continue to focus on anchoring inflation expectations near the midpoint of the inflation target range in the interest of balanced and sustainable growth. In this persistently uncertain environment, future policy decisions will continue to be highly data dependent, sensitive to the assessment of the balance of risks to the outlook, and will seek to look through temporary price shocks. The implied path of policy rates over the forecast period, generated by the quarterly projection model, indicated no changes to the repo rate. This remains a broad policy guideline which could change in either direction from meeting to meeting in response to new developments and changing data and risks. That concludes the statement, and as usual, I would open the floor for questions. And please identify yourself and the name of the media house that you represent, and we will deal with your questions. Amukela.
Good afternoon, Governor. I'm Bata from Bloomberg News. Governor, in the context of the attacks that we saw in the Saudi oil refinery over the weekend, does the bank's forecasts for oil prices factor the risks emanating from that particular attack, particularly when you think of the supply disruptions that we could see and oil price shocks, particularly in the context that we see that you have cut your oil price forecasts for the next 2 years? So do those factor in any shocks or disruptions that may impact the oil price?
Yes, ma'am.
Governor, it's Pranesha from Bloomberg. In their previews, many economists predicted that the SARB would keep the rate unchanged due to concerns about fiscal risks and also the threat of a Moody's downgrade. Did those factor into your discussions at all, and to what extent? Thank you.
Is that it? No other? Okay. Amakala, the forecast that we tabled was done last week. That was before the attack, so it doesn't factor those things in. But be that as it may, when you have the attack, the question is always going to be how quickly can production be restored, and that will have an effect on the price going forward. But our approach when these kinds of events happen is to assess: is this a once-off shock, and could we see through that? And that's exactly what we do. We look at the thing, and if we find that it was a once-off shock, we look through it and see whether it changes the outlook. If it does, then there might be a need to adjust a policy to deal with those kinds of shocks, whether they are positive or negative. Pinesha, fiscal risks and possible Moody's downgrade, those are always at the back of our mind. They are unknowns. So it's difficult to factor them into anything that we do because we do not know what they would be. Moody's will be doing its visit or making its decision sometime in November, and when that comes, we will deal with it then. It's a question of, if it is a downgrade, is that downgrade in current prices or not? If it is in current prices, it should not have an effect. But if it is not in current prices, you should expect that there would be outflows of capital, and that will manifest itself in the exchange rate. And the way we think about it is that it's a shock. We do not respond to shocks in that manner. We would then look as to whether second round effects kick in. If second round effects kick in, then we would respond to those second round effects rather than to the first round shock.